Okay, so you want to buy as Mr. Beast, not be him. Own him. Walk in, write a check, and walk out holding the biggest attention machine the internet has ever produced. The channel, the chocolate, the Amazon deal, all of it. So here's the only question that matters. What would that actually cost? And here's the twist that makes this one of the strangest deals in business. And here's the number that frames the entire deal. In its most recent full year, Beast Industries pulled in somewhere between $600 million and $900 million in revenue, depending on which figure you trust. Enormous. And in that same stretch, it lost money. Reports put one recent year's losses north of $110 million. 3 straight years of losses. So before you spend a dollar, sit with the paradox. You are looking at a company that generates the revenue of a small conglomerate, loses money every single year, and that private investors recently agreed is worth around $5 billion. $5 billion for a company that loses money. That number isn't a mistake. By the end of this video, you'll understand exactly why a rational investor would pay it, and exactly why you might be insane too. Let's go shopping. We're going to walk this empire asset by asset, put a rough price tag on each piece, add it all up, and then I'm going to tell you the one reason you probably can't buy any of it. Start with the crown jewel, the main channel. On paper, this is the most valuable media property a single person has ever built. Nearly 500 million subscribers. Around 5 billion views a month across his channels. If you're buying Mr. Beast, this is the thing you think you're buying. Except here's the first shock of your due diligence. The channel loses money. His media division booked revenue roughly comparable to his chocolate brand in a recent year, $200 million, but lost close to $80 million after production costs. Because a single main channel video now reportedly costs between $3 and $5 million to make. Across a year, content spending runs around $250 million. That's more than many Hollywood studios spend on an entire feature film. Except he does it over and over, all year long. So as a buyer, you have to ask the uncomfortable question, why would I pay a premium for an asset that bleeds cash? And this is the single most important idea in the entire deal, so lock it in. You are not buying a video business. You are buying the most powerful distribution engine on planet Earth. The channel doesn't make money directly, it makes money possible. It's a 100 million view megaphone that can launch any product, sell any sponsorship, and build any brand instantly for free. In the traditional world, companies spend millions of dollars just to get in front of an audience. Mr. Beast is the audience. He can put a product in front of 100 million people with one upload at zero marketing cost. So what's the channel worth on its own? Honestly, as a standalone cash machine, not that much because it barely breaks even. But as a distribution weapon that makes everything else in the portfolio possible. It's the reason the whole thing is worth $5 billion. You're not buying the profit, you're buying the reach. Keep that distinction in your head, because it's the key to every other price tag we're about to put down. Now let's talk about the asset that a smart buyer would actually get out of bed for. The chocolate. Feastables launched in 2022, and in a recent year, it did around $250 million in revenue, with projections pushing past $500 million, and, crucially, it turned an actual profits of more than $20 million. For the first time, the candy out-earned the entire media empire. It's now stocked in over 30,000 retail locations across North America. Walmart, Target, the checkout aisle. Stop and appreciate what just happened, because this is the whole magic trick. The videos lose money, the chocolate makes money, and every single video quietly features the chocolate to 100 million people who trust him. That's the flywheel, and it's the most valuable thing in this entire company. Here's how it spins. You spend $5 million on a spectacular video. 100 million people watch it. Inside that video sits a Feastables bar. That's a Super Bowl ad. Except a Super Bowl spot costs $7 million and airs once, and this one airs forever to the most loyal audience on the internet for free. Those viewers buy chocolate. The chocolate profit funds an even bigger video. The bigger video reaches even more people. Round and round. So here's the reframe that should change how you value this whole deal. MrBeast doesn't run a video company that happens to sell candy. He runs a candy and consumer products company that happens to use the most expensive marketing department on earth. The videos are the ad budget. Feastables is the business. What's Feastables worth as a buyer? This is where real money sits. A fast-growing, profitable consumer packaged goods brand doing $250 million in sales with a built-in zero-cost distribution channel no competitor on earth can replicate. That's the kind of asset that alone could justify $1 to $2 billion, depending on how fast it keeps growing. Hershey and Mars spend fortunes fighting for shelf space and paying for ads. MrBeast gets both for the price of a video he was making anyway. If you're buying this empire for one reason, it's not the channel, it's the chocolate the channel exists to sell. Next on the shelf, Beast Games, the big media play. This is MrBeast trying to graduate from YouTube economics into Hollywood economics. A deal with Amazon Prime Video. A reality competition show pitched as the biggest in television history, with a $5 million grand prize and a reported production budget north of $100 million. Multiple seasons now. On paper, it's the asset that proves he's not just a YouTuber. He's a media mogul. But as a buyer running due diligence, this is where you start finding problems. Because Beast Games reportedly blew past its $100 million budget, forcing MrBeast to personally cover tens of millions in cost overruns. That's the danger of Hollywood economics. The costs are enormous and they don't stay put. And there's a second problem, a much more serious one, that we'll get to when we open the risk file. For now, just mark it. Beast Games is a prestige asset. It buys credibility, it buys a foothold in streaming, and it extends the brand into living rooms. But it is expensive, it's unpredictable, and it came attached to a lawsuit. As a line item on your acquisition, it's less profit engine and more expensive trophy that makes the rest of the empire look bigger. Value to a buyer, real but soft. You're paying for the relationship with Amazon and the proof that the brand travels beyond YouTube, not for reliable earnings. Now let's go through the rest of the shelf quickly because your thumbnail-worthy empire has a whole row of other ventures, and a real buyer has to price each one, including the ones that failed. ViewStats, a software analytics tool for other creators. This one's interesting because it's the only asset that isn't downstream of MrBeast's own audience. It sells to others YouTubers. Software carries high margins and recurring revenue, which investors love. Small today, but strategically valuable. A genuine plus on the balance sheet. Step, the fintech app. In February 2026, Beast Industries bought Step, a teen banking app with 7 million users, and officially entered financial services. Now think about why a chocolate and video company buys a bank. Same reason as always, distribution. Fintech companies spend millions of dollars to acquire each new customer. MrBeast can acquire them with a single 15-minute video about money. He'd already filed to trademark MrBeast Financial. So this isn't a novelty, it's the flywheel pointed at banking. As a buyer, this is an option on an entirely new industry. Bought cheap because MrBeast supplies the one thing fintech can't buy, young users, by the millions for free. Merch and the online shop. Apparel, accessories, limited drops. Tens of millions a year, decent margin, entirely dependent on the channel. Solid, unglamorous, real. Beast philanthropy. The charity arm. It doesn't make you money, but don't dismiss it. In this business, reputation is an asset, and the philanthropy converts attention into goodwill, which converts into audience loyalty, which converts into everything else. It's a marketing asset dressed as a charity, and it genuinely works. And now, the cautionary tale on the shelf. Mr. Beast Burger. Remember this one. A virtual restaurant brand that, at its peak, looked like a huge win. It collapsed. Mr. Beast ended up suing Jog, his operating partner, alleging the food quality was damaging his brand. And that's the most important line in your entire due diligence. So hear it. The Mr. Beast magic is not automatic. Slap his name on a bad product with a bad partner, and it fails, publicly and fast. The burger proves the flywheel isn't magic. It's a machine, and machines break when you feed them garbage. So as a buyer, Mr. Beast Burger isn't an asset you're paying for. It's a warning you're pricing in. All right, let's put the calculator on the table and add up what we've got. The main channel barely breaks even on its own, but it's the distribution engine that powers everything. Call its standalone value modest, but its strategic value enormous. Feastables, the real prize, a profitable, fast-growing consumer brand plausibly worth $1 to $2 billion on its own. Beast Games and the Amazon relationship, real but soft, a prestige asset. Viewstats, Step, merch, philanthropy, a stack of smaller pieces, some genuinely valuable, some strategic options on new industries. And Mr. Beast Burger, a zero and a warning. Add the parts up the way an analyst would, and you land somewhere in the low billions of dollars of tangible, defensible value. And yet, investors put the whole thing at $5 billion. Recent funding rounds, one led by a firm called Alpha Wave Global, anchored that $5 billion number. There's talk of it reaching $15 billion in a few years if the growth holds. There's even talk of an IPO. So here's the question that should be bugging you. If you add up the actual assets and get a few billion, where does the grests of that $5 billion valuation come from? What are investors paying for that doesn't show up on the shelf? The answer is the most important and most dangerous part of the whole deal. You're not paying for the chocolate. You're not paying for the channel. You're paying for a bet. Specifically, a bet on one man's ability to keep commanding the attention of 500 million people. That's the invisible asset. It's called the audience, and it's the most valuable and most fragile thing in modern business. Every dollar of that $5 billion valuation above the hard assets is investors saying, "We believe this attention machine keeps growing, keeps launching profitable products, and eventually either goes public or gets acquired for far more than we paid." The valuation isn't based on what the company earns today. It earns a loss. It's based on what that audience could be converted into tomorrow. Banking, wellness, games, toys, whatever comes next. That's why a money-losing company is worth $5 billion. You're not buying a business. You're buying a distribution monopoly over the most engaged young audience on earth, and betting the man at the center of it doesn't lose his grip. Which means before you sign anything, you'd better open the risk file. Because a bet on one man has exactly the failure modes you'd expect. Any serious buyer, before writing a check this big, hires people to find every reason not to. So let's do that. Company is one person. If Mr. Beast burns out, gets injured, has a scandal, or simply loses his creative touch, every asset degrades at the same time. The channel shrinks, so the sponsorships get cheaper, so the chocolate stops selling itself, so the fintech app loses its distribution, so the valuation collapses. It's all one bet on one man's continued output. There is no version of this company that survives him losing the audience. In acquisition terms, that's the single scariest sentence you can write about a target. Red flag number 3, reputation risk. And here's where the file gets ugly. Because a creator's reputation is the balance sheet, and in late 2024, that reputation got stress-tested twice, publicly at the same time. First, Lunchly. In September 2024, MrBeast, with fellow creators Logan Paul and KSI, launched those lunch kits, pitched as a healthier alternative to Lunchables. Weeks later, a well-known YouTuber, Rosanna Pansino, filmed herself opening a Lunchly pizza kit that was still within its expiration date and found the cheese covered in bright blue mold. It went viral instantly. Other customers posted their own moldy kits. A mocking hashtag trended. Reports said the FDA received more than 10 complaints, including at least one person claiming they got sick. The company defended its safety process, and two of the founders reportedly laughed the backlash off on a podcast. But as a buyer, you don't care who was right. You care that a product problem became a trust problem overnight, aimed at an audience of kids. That's reputation risk in one clip. And second, and far more serious, Beast Games. And I need to be careful and precise here because these are allegations. The case is still in active litigation as of early 2026. Nothing has been proven in court, and MrBeast's side has contested the claims. But a group of contestants filed a proposed class action lawsuit against MrBeast's production companies and Amazon. The allegations that contestants were underfed, deprived of adequate medical care and sleep, and pushed into unsafe conditions, with some reporting injuries. The suit also alleged a hostile environment and sexual harassment. And, critically for a buyer, it alleged the contestants were misclassified to avoid paying minimum wage, overtime, and employment taxes. The plaintiffs said they were seeking damages, likely in the millions. Stack that on the budget overruns, and Beast Games becomes a case study in the exact risk that haunts this whole company. The pressure to scale faster than your controls can handle. To go bigger, spend more, produce harder, until the boring stuff you skipped, the safety, the labor law, the quality control, sends you a bill in the form of a lawsuit and a wave of bad press. Here's the thing, every buyer needs to understand about these red flags. None of them happened because MrBeast is bad at what he does. He is arguably the best there has ever been. They happened because they're baked into the structures, a money-losing engine that has to keep scaling, resting entirely on the reputation and stamina of one human being. You're not buying those risks by accident. You're buying them by definition. They come standard. So you've walked the empire. You've added up the assets. You've read the risk file. You've decided, maybe, that $5 billion is a price you'd pay for the most powerful distribution machine on Earth. Here's the twist. You can't have it. Because MrBeast owns a little over half of Beast Industries, and he reinvests nearly everything, and he has shown no interest in selling the thing he spent his whole life building. Every dollar that comes in gets fired back into the next bigger video, the next acquisition, the next venture. That's why he's a paper billionaire who keeps almost no cash, who, famously, borrowed money from his own mom to help pay for his wedding. The billionaire and the guy short on cash are the same person on the same day. His wealth isn't in a bank account. It's locked inside a company he refuses to cash out. And here's the beautiful, maddening part. That refusal is exactly what makes it so valuable. The reason investors will pay $5 billion and talk about 15 is precisely because he keeps reinvesting instead of taking the money out. He's not running the company to be profitable today. He's running it to be enormous tomorrow. A buyer who wanted steady profits would ruin the very thing that makes it worth buying. So the honest answer to what would it cost to buy MrBeast is more than you have for a piece he won't sell of a company that's valuable because he won't sell it. But there might be one way in. The company's CEO has openly floated the idea of an IPO, even the idea of letting fans own equity. So the real answer to "Can you buy Mr. Beast" might not be a private check for billions. It might be one day a single share. You wouldn't own the empire. You'd own a sliver of the bet. Which, when you think about it, is the most Mr. Beast possible ending, turning his own audience into his shareholders. So let's end where any serious buyer would, by imagining the two futures you'd be buying into. Same company, same price, two completely different outcomes. The good scenario: you buy in. The flywheel keeps and finally turns a profit as the new CEO cuts costs. Step turns Mr. Beast's audience into millions of banking customers at zero acquisition cost. The audience grows past 500 million. The company goes public many times over. You didn't buy a company, you bought the future of media early. The bad scenario: C chi, C chi, C chi chi, C chi chi, C chi chi. But the algorithm shifts and views soften. A couple of big productions flop in a division that was already losing money. Another product ships with a defect and trends for the wrong reasons. The lawsuit drags on and spooks sponsors. Cocoa prices spike and eat the chocolate margin. And the man at the center, the entire asset, burns out, or steps back, or simply stops being the biggest thing on the internet. And because every asset depends on him, they all sync together. The $5 billion valuation you paid becomes a number nobody will ever pay again. You'd have bought the exact same company either way. The exact same channel, the same chocolate, the same empire. The only thing that changed was which side of a handful of coin flips you landed on. A viral flop, a lawsuit, a burned-out founder, a shift in the algorithm. That's not bad luck. That's the actual nature of what you'd be buying. The difference between a genius acquisition and a $5 billion mistake is measured entirely in things no buyer can control. If you could, you wouldn't be buying a chocolate company, or a YouTube channel, or a media empire. You'd be buying the single most powerful attention machine ever built by one human being, and betting with billions of dollars that he never lets go of the attention. Every number in this video, the money-losing channel, the profitable chocolate, the $5 billion valuation on a company that loses money, the paper billionaire borrowing from his mom, points to the same strange truth. The value was never in the videos, or the candy, or the deals. It was in this bet. The bet that one man can hold the gaze of 500 million people and keep converting that gaze into something new forever. The assets are just the receipts. The real thing you'd be buying can't be put on a shelf, or a balance sheet, or in a truck. It's attention. And the moment that attention wanders, everything you paid for is worth exactly nothing.